All right, Kenzo John Ag here with Market Acme, and I need you to lock in for the next several minutes because what I'm about to break down is a signal that just came directly from inside the Federal Reserve, a signal that contradicts everything you've been told about the rate cut timeline, and a 48-hour window before the Fed minutes either confirm or deny what one of the most influential central bankers in America just revealed publicly. This is not speculation. This is not theory. This is not another recycled headline from mainstream financial media. This is about a specific statement from Chicago Fed President Austan Goolsbee that the market has not fully processed, inflation data that changes the entire calculus, and a positioning opportunity that closes the moment the Fed minutes hit at 2 p.m. Eastern today. I'm talking about a potential shift from the single rate cut that policymakers forecast in December to what Goolsbee explicitly called several rate cuts if inflation continues its downward trajectory. I'm talking about CPI data that came in at 2.4%, the lowest reading since July, that may have just unlocked the door for more aggressive easing than anyone expected. And I'm talking about a Fed that is about to reveal, in the January meeting minutes, whether the internal debate supports Goolsbee's dovish signal or whether he's an outlier who will be overruled by the broader committee. Let me give you the specific data points that are driving this analysis because I want you to understand that everything I'm about to share comes from official Fed communications, Bureau of Labor Statistics releases, and institutional analysis that you can verify yourself, but almost no one is connecting properly. On February 17th, Chicago Fed President Austan Goolsbee told CNBC that there is potential for more interest rate cuts this year, but only if inflation continues to dip toward the central bank's 2% target. He explicitly said that if price hikes linked to tariffs are a one-off, the Federal Open Market Committee could lower rates more than the single-cut policymakers had forecast in December. Read that again. A Federal Reserve president is publicly stating that the December forecast of a single rate cut could be wrong. He's saying the Fed could cut several times this year. And he's conditioning this on inflation data that just came in significantly better than expected. This is not some analyst at a hedge fund making predictions. This is not a commentator on financial television speculating about policy. This is a voting member of the Federal Open Market Committee, the committee that actually sets interest rates, telling you that the rate cut path could be significantly more aggressive than what the market is currently pricing. And the inflation data supports his case. The Bureau of Labor Statistics reported on February 13th that the CPI rose just 0.2% in January, the smallest gain since July. Overall inflation unexpectedly dropped to 2.4% on a year-over-year basis, down from the previous 2.7% annual pace. Core inflation, which filters out volatile food and energy prices, ticked down to 2.5% on a year-over-year basis from 2.6%. Americans saw relief on the costs of everyday purchases. Electricity prices ebbed. Gasoline prices dropped by the most in nearly a year. Grocery prices rose the least since July. The energy index fell 1.5%, partially offsetting increases in shelter and food. Wells Fargo economists said in a note that they found the report encouraging. Quote, "Tariff-induced price hikes probably have not fully worked their way through the data, but we are closer to the end than the beginning of this source of higher prices." End quote. This is the data that Goolsbee is pointing to when he says multiple rate cuts could be warranted. This is the data that could shift the Fed from its December forecast of a single cut to something much more aggressive. And this is the data that the market has not fully priced in because traders are still anchored to the hawkish narrative that dominated January. But here's where it gets interesting. The Fed minutes from the January meeting are being released today at 2 p.m. Eastern. These minutes will reveal the internal debate among policymakers about the balance of risks between inflation and employment. They will show whether Goolsbee's dovish signal is supported by his colleagues or whether he's out on a limb. Reuters reported that the minutes are expected to provide more detail on why central bankers kept interest rates on hold last month and what it may take to convince them further rate cuts are warranted. In his press conference after the January meeting, Fed Chair Jerome Powell said there had been broad support among policymakers to hold the policy rate steady in the current 3.5% to 3.75% range. But here's the key insight that most investors missed. Powell also said that the risks to inflation and employment were moving more into balance. Quote, "We still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to employment have probably both diminished a bit." End quote. This is crucial. The Fed has been stuck between two mandates, maximum employment and 2% inflation. When inflation was running hot and the labor market was showing signs of weakness, policymakers faced a difficult trade-off: cut rates to support employment and risk reigniting inflation, hold rates to fight inflation and risk pushing unemployment higher. But Powell is saying that tension is easing. Both risks are diminishing. The labor market is stabilizing, as evidenced by the stronger than expected January jobs report, with 130,000 payrolls added against expectations of 55,000. And inflation is coming down, as evidenced by the CPI dropping to 2.4%. When both risks are diminishing, the Fed has more room to maneuver. They can afford to be patient, but they can also afford to cut more aggressively if the data supports it. And that's exactly what Goolsbee is signaling. Now let me introduce you to the internal debate that's happening within the Fed, because this is where the real institutional analysis happens and where most retail investors completely miss the signal. There's a tension between the dovish camp, represented by Goolsbee, and the more cautious camp, represented by Governor Michael Barr. On the same day that Goolsbee was talking about multiple rate cuts, Barr said the current rate cut pause would likely last for some time, before there's enough information in hand to be assured inflation is in decline. Barr also pushed back on the White House argument that a surge in productivity driven by artificial intelligence will give the Federal Reserve room to lower interest rates without stoking inflation. In a speech at the New York Association for Business Economics, Barr said that even if AI ultimately lifts growth, it is unlikely to justify easier monetary policy anytime soon. In fact, if the technology meaningfully boosts long-run productivity, he said it could actually push equilibrium interest rates higher, not lower. This is the hawkish counter to Goolsbee's dovish signal. Two Fed officials, same data, completely different interpretations. One sees multiple rate cuts, the other sees an extended pause. The Fed minutes today will reveal which camp has more support within the committee. If the minutes show broad support for patience and concerns about inflation persistence, the market will take that as hawkish and push back rate cut expectations. If the minutes show growing comfort with the inflation trajectory and openness to multiple cuts if the data cooperates, the market will take that as dovish and bring forward rate cut expectations. Citi analysts wrote on Tuesday, quote, "The Fed is prepared to lower rates further this year if inflation cools. This should be reflected in FOMC minutes." End quote. This is institutional consensus that the minutes could confirm the dovish shift that Goolsbee is signaling, and if that happens, the repricing in markets could be significant. Now let me show you why this matters so much for your portfolio, because understanding Fed policy is only valuable if you understand the transmission mechanism to asset prices. The federal funds rate, which the Fed holds at 3.5% to 3.75%, guides interest rates for consumers and investors across the economy. Auto loans, student loans, home equity loans, credit cards, mortgages, business loans, all of these are directly or indirectly tied to the Fed funds rate. When the Fed cuts rates, borrowing costs fall. Businesses can invest more cheaply. Consumers can refinance debt at lower rates. Housing becomes more affordable. The economy gets a tailwind. But here's what matters for investors. Lower rates also boost asset prices. Stock valuations rise because the discount rate applied to future earnings falls. Bond prices rise because yields fall. Real estate prices rise because mortgage rates fall. Gold rises because the opportunity cost of holding a non-yielding asset declines. If Goolsbee is right and the Fed delivers several rate cuts this year instead of one, the asset price implications are enormous. The market is currently pricing about 60 to 65 basis points of cuts this year, which implies 2 to 3 quarter-point cuts. But if inflation continues to decline and the Fed becomes more aggressive, we could see 100 basis points or more of cuts, which would be a significant repricing event. The investors who position ahead of that repricing will capture the gains. The investors who wait for confirmation will be buying after the move has already happened. Now let me give you the historical context that frames this entire discussion, because understanding where we are in the policy cycle is essential for positioning. The FOMC voted 10-2 to hold interest rates steady in January after 3 consecutive quarter-point cuts in its last 3 meetings of 2025. This pause is typical Fed behavior. They cut aggressively when they're concerned about economic weakness. Then they pause to assess the impact of those cuts before deciding on the next move. But here's what's different about this cycle. The Fed cut rates into economic strength, not weakness. The January jobs report showed payrolls rising by the most in more than a year. beating estimates by more than double. The unemployment rate unexpectedly fell to 4.3% from 4.4%. GDP is running at an annualized rate of around 3%. This is not an economy that needs emergency rate cuts. This is an economy that is performing well despite elevated interest rates. The Fed cut rates not because the economy was crashing, but because inflation was falling and they wanted to normalize policy from restrictive levels. That changes the calculus for future cuts. The Fed doesn't need to cut aggressively to save the economy. They can afford to be patient, but they also don't need to hold rates restrictive if inflation is genuinely returning to target. They can afford to cut further if the data supports it. Goolsbee's signal is that the data is starting to support it. The CPI at 2.4% is getting close to the 2% target. Core inflation at 2.5% is trending in the right direction. And the tariff-related price pressures that boosted inflation in late 2025 appear to be fading. If this trend continues, and Goolsbee clearly believes it will, the Fed has room to deliver multiple cuts without risking their credibility on inflation. That's a significant shift from the December forecast of a single cut. Now let me talk about what specific assets will benefit from this potential dovish shift, because understanding the transmission mechanism is essential for positioning. The first asset class that benefits from rate cuts is bonds, particularly long-duration treasuries. When rates fall, bond prices rise. The longer the duration, the more sensitive the price is to rate changes. If the Fed delivers several cuts this year instead of one, long-duration Treasury bonds could see significant price appreciation. But here's the nuance. The bond market has already priced in some rate cuts. The question is whether the cuts will be deeper than expected. If Goolsbee is right and inflation continues to fall, the bond market could reprice for more cuts than currently expected, driving yields lower and prices higher. The second asset class that benefits is equities, particularly growth stocks and interest rate-sensitive sectors like real estate and utilities. Lower rates reduce the discount rate applied to future earnings, which increases the present value of growth stocks. Lower rates also reduce borrowing costs for real estate companies and make utility dividend yields more attractive relative to bond yields. If the Fed signals a more dovish path, expect growth stocks to outperform value stocks and expect rate-sensitive sectors to see a bid. The third asset class that benefits is gold. Gold has no yield, so when interest rates are high, there's an opportunity cost to holding gold instead of bonds. When rates fall, that opportunity cost declines and gold becomes more attractive. Additionally, rate cuts typically weaken the dollar, and gold is priced inversely to the dollar. If the Fed delivers multiple cuts this year, gold could see significant upside. The current price around $2,950 per ounce does not reflect a world where the Fed is cutting aggressively. A repricing to $3,200 or $3,500 is entirely plausible if the dovish scenario plays out. The fourth asset class that benefits somewhat counterintuitively is the dollar in the short term. Wait, doesn't the dollar weaken when the Fed cuts rates? Yes, in general. But the key is relative expectations. If the market is already pricing in cuts and the Fed delivers exactly what's expected, there's no repricing and the dollar may actually strengthen on the certainty. The risk to the dollar comes if the Fed cuts more than expected, signaling more concern about the economy than the market anticipated. That would weaken the dollar. But if the Fed cuts in line with expectations or less than expected, the dollar could actually strengthen. This is why understanding the Fed's communication is so important. The market moves not on what the Fed does, but on what the Fed does relative to expectations. Goolsbee's signal of multiple cuts, if confirmed in the minutes, could shift expectations higher, which would then create room for the Fed to meet those expectations without shocking the market. Now let me address the risk factors that could derail the dovish scenario because sophisticated investors always consider both sides of the trade. The first risk is that inflation re-accelerates. The CPI at 2.4% is encouraging, but it's still above the Fed's 2% target. Core inflation at 2.5% is still elevated, and services inflation, which Goolsbee himself acknowledged remains elevated, is sticky and difficult to bring down. If the next few inflation readings come in hot, if tariff effects prove more persistent than expected, or if energy prices spike due to geopolitical developments, the dovish case evaporates. The Fed will not cut rates into rising inflation. They will hold or potentially even hike if inflation gets out of control. The second risk is that the labor market reheats. The January jobs report showed 130,000 payrolls added, significantly above expectations. If employment continues to surprise to the upside, it signals that the economy doesn't need rate cuts and gives the Fed reason to remain restrictive. The Fed's mandate is maximum employment consistent with 2% inflation. If employment is strong and inflation is above target, there's no urgency to cut. The Fed will wait until they see clear evidence that inflation is sustainably returning to target before easing further. The third risk is geopolitical escalation. The articles mentioned progress on Iran nuclear talks and Ukraine-Russia peace negotiations. If those negotiations break down, if tensions escalate in the Middle East, or if new trade conflicts emerge, risk appetite could collapse and the Fed's calculus could change dramatically. Geopolitical uncertainty typically strengthens the dollar as a safe haven and complicates Fed policy. The Fed prefers to operate in a stable environment where they can focus on their dual mandate without having to react to external shocks. The fourth risk is that the Fed minutes today disappoint the dovish camp. If the minutes show hawkish concern about inflation, if they reveal skepticism about further cuts, or if they suggest the committee is more divided than Powell's press conference indicated, the market will reprice expectations lower and rate-sensitive assets will sell off. This is why today's minutes are so important. They will either confirm Goolsbee's signal or contradict it, and the market will move accordingly. Now let me walk you through the specific positioning framework that sophisticated investors are using right now, because understanding the setup is only valuable if you take action. The first position is duration exposure in the bond market. If you believe the dovish scenario is more likely, increasing allocation to long-duration treasuries or treasury ETFs allows you to benefit from falling yields. The key is to size the position appropriately given the risk that inflation surprises to the upside. A position of 10% to 15% of portfolio in long-duration treasuries provides meaningful exposure to the rate cut scenario while limiting downside if the thesis is wrong. The second position is gold and silver. Physical gold and silver provide a hedge against both dollar weakness and monetary policy uncertainty. If the Fed cuts aggressively, gold benefits from lower opportunity costs and a weaker dollar. If the Fed holds and inflation persists, gold benefits from inflation hedging demand. A position of 10% to 20% of portfolio in physical gold and silver provides structural protection regardless of which scenario plays out. The third position is quality growth equities. If rates fall, growth stocks benefit disproportionately. The key is to focus on quality, meaning companies with strong balance sheets, sustainable competitive advantages, and pricing power that can withstand economic uncertainty. Avoid speculative growth that depends on continuous access to cheap capital. Focus on profitable technology companies, healthcare innovators, and consumer franchises that will benefit from lower rates, but don't need them to survive. The fourth position is reduced cash allocation. Cash has been attractive over the past 2 years with money market rates above 4%. But if the Fed is cutting rates, cash yields will decline, and the opportunity cost of sitting in cash will increase. The action is to deploy excess cash into the positions I've outlined before the repricing happens. Once the Fed confirms a more dovish path, yields will fall and asset prices will rise. You want to be positioned before that confirmation, not after. Now let me talk about the specific timeline and catalysts you should be watching because timing is essential for capturing the opportunity. Today at 2 p.m. Eastern, the Fed releases the January meeting minutes. This is the first major catalyst. Watch for language around the balance of risks, the inflation outlook, and the level of agreement on holding rates steady. Dovish language around potential future cuts is positive. Hawkish language around inflation concerns is negative. Friday brings the preliminary Q4 GDP estimate and the core PCE inflation reading. GDP is expected at 3% annualized. PCE is the Fed's preferred inflation gauge. Any surprises in either direction will move rate cut expectations and asset prices. The Fed next meets on March 17-18. Investors are expecting rates to remain on hold, but the statement and press conference will provide updated guidance on the path forward. If inflation continues to decline between now and March, Powell's tone could shift more dovish, setting up cuts in June or sooner. The key dates to watch are today's minutes release, Friday's data dump, and the March 17-18 meeting. These are the catalysts that will confirm or deny the dovish thesis. Here's what I want to emphasize because this is the core insight that separates sophisticated positioning from naive speculation. Fed communication is as important as Fed action. The market moves on expectations, not just outcomes. If the Fed signals a more dovish path, asset prices will reprice before any actual rate cut happens. This means you need to position ahead of the confirmation, not after. If you wait for the Fed to actually cut rates before adding duration exposure or gold exposure, you're buying after the move has already happened. The opportunity is in anticipating the shift, not reacting to it. Goolsbee just gave you a signal. The CPI data supports that signal. The Fed minutes today will either confirm or contradict it, and the market will move accordingly. Let me also address the contrarian view, because intellectual honesty requires considering the other side. The bears argue that Goolsbee is just one voice on the committee, and that his dovish signal doesn't represent consensus. They point to Barr's more hawkish comments about an extended pause. They note that the labor market remains strong and doesn't require Fed support. They argue that inflation at 2.4% is still above target, and the Fed should not declare victory prematurely. These are legitimate concerns, and they could prove correct. If the Fed minutes show hawkish consensus, if inflation surprises to the upside, or if the labor market continues to exceed expectations, the dovish thesis fails and rate-sensitive assets will sell off. This is why position sizing matters. Don't bet the portfolio on a single thesis. Allocate meaningfully to benefit if you're right, but preserve capital if you're wrong. The goal is asymmetric positioning, where the upside significantly exceeds the downside. Here's what I want you to do right now. First, mark your calendar for 2 p.m. Eastern today. The Fed minutes release is the immediate catalyst that will confirm or contradict the dovish signal. Have a plan for both scenarios before the release. Second, assess your current portfolio exposure to rate-sensitive assets. If you're underweight duration, underweight gold, and overweight cash, you're positioned for the hawkish scenario. If the dovish scenario plays out, you'll underperform. Third, consider adding incremental exposure to long-duration bonds, gold, and quality growth equities before the minutes release. This is a tactical position, not a permanent allocation. Size it appropriately for the uncertainty. Fourth, watch the data releases on Friday. GDP and PCE will provide the next data points on whether the dovish thesis is playing out. Strong GDP and falling inflation support the case for multiple cuts. Weak GDP or rising inflation complicate the picture. Fifth, subscribe to this channel and turn on notifications because I'm going to be covering the Fed minutes in real time, breaking down the implications, and providing actionable analysis as the situation develops. Here's the question I want you to answer in the comments because this helps me understand where this community stands and what topics to prioritize. Do you believe the Fed will deliver multiple rate cuts this year as Goolsbee is signaling? Or do you think the December forecast of a single cut will prove correct? And how are you positioning your portfolio ahead of today's minutes release? Let me know because the feedback from this community shapes the analysis I provide. Chicago Fed President Goolsbee just signaled that multiple rate cuts are possible this year. The CPI came in at 2.4%, the lowest since July. Core inflation is trending down to 2.5%. The January jobs report showed a resilient but stabilizing labor market. And the Fed minutes released today at 2 p.m. Eastern could confirm that the committee is open to more aggressive easing than the December forecast suggested. These are not opinions. These are facts that you can verify from official sources. The only question is what you're going to do with this information. You can wait for the Fed to actually cut rates and then react, buying after the move has happened and giving up the gains to those who positioned ahead. Or you can recognize the signal, understand the catalysts, and position before the confirmation comes. Share this video with anyone you know who is sitting in cash waiting for clarity from the Fed. The clarity is coming today at 2 p.m. Eastern. The question is whether they'll be positioned to benefit from it. This is Kenzo John Ag with Market Acme. The signal has been given. The catalyst is 48 hours away. And the positioning opportunity closes the moment the minutes hit. Make sure you're ready. I'll see you in the next video.